check on our website to see which ones are upcoming. And then any donations that are given to this program directly fund the Scholars Program. And the Scholars Program is one of our programs that we have for young ladies that are in 11th and 12th grade. Those young ladies are prepared for college specifically by helping them develop financial literacy, feminine health, scholarship research and applications, self-defense, everything that they're going to need whenever they go off to college and they're by themselves. And we also give them financial donations whenever they graduate from the TWST Scholarship Program. And the financial donations will go towards their college tuition to help alleviate any financial needs whenever they go off to college. So 100% of your donations that you've given all go to those TWST scholars financial scholarships whenever they graduate. So thank you very much for your donations. And we'll send another link after this meeting, just so that if you didn't see it, you have another chance to see it and donate. What we'll do now is I'm going to turn the floor over to Ms. Lauren Thomas to introduce our wonderful speaker for today.
Thanks, Sydney. And I have to echo you. We're so excited for all of you to be here today. I was telling Cairo and Sydney before this workshop that I don't know a lot about investments in stocks at all. So I was personally really excited to attend too. But just to introduce Cairo, she's a native of the Houston area, but born and raised in Baytown. She attended Trinity University in San Antonio, where she earned her degree in mathematics finance. Soon after college, she began her career in the financial services industry. And she's super excited to volunteer with TWST today and present on investments in stocks. And her main goal for all of you is really to make sure she provides a solid foundation for you guys to be able to start investing in the stock market. Because just speaking from personal experience, it's just one of those things. Outside of a 401k, maybe you don't have as much familiarity in it, or you haven't worked in that space before and know how to navigate it. So, or maybe, you're one of the girls in the Scholars Program just starting out. But I think as you're going to learn today, it's never too early to start investing or thinking about it. So without further ado, I'll turn it over to Cairo, who's going to be leading us. And I'm also off camera, but I'm still here, still listening. So take it over, Cairo.
Thank you all for allowing me to be here today. I was going to pretty much give the same type of introduction, but about myself. So Lauren pretty much said it all. I went to Trinity University. I got my degree in mathematical finance. I've got about 3 years of experience in the financial services industry. I have 2 financial services licenses, my Series 6 and Series 63. I also have an insurance license, but that is not what we're talking about today. It's mostly about investments. And I just wanted to say thanks again for letting me present today. Like I said, I'm really excited about presenting today. So I can't wait to get in there. If you guys have any questions along the way, I think at the end we're going to do a question and answer session, but if there's any questions along the way that I could clarify something, let me know. I'll try to ask questions in between too, just so it can be a little bit of a conversation. So first, to get started, we're going to talk about what is the stock market. So I'll start this off by asking, does anyone have an idea, like what do they think of when they hear the stock market? You can put it in the chat too, I can see the chat, or you can say it out loud.
Isn't it like where people put their investments, like
Yes.
when they invest in companies?
Yes, exactly. So to get us started off, so investing, so there's the stock market, but before we get to the stock market, there are stocks, which is where you actually invest into an individual company. So these are like the official definitions. A stock is a security that represents the ownership of a fraction of a corporation or company. So you are owning a little piece of that company. These stocks are, you can buy them and sell them. This is also called trading on a stock exchange. And that's the foundation of most people's portfolios. When they start investing, they start with stocks. Now, a stock exchange is the actual marketplace. So think of it like you're going to buy, like, let's say, you're purchasing like shoes. Shoes are the actual item that you're buying, and you go to a store or online place to buy the shoes. So the stock exchange is where you actually go to trade, buy, and sell the stocks that you're purchasing. There are different examples you may have heard of, like the New York Stock Exchange or NASDAQ. You hear those phrases, or if you have like an iPhone, I know that they will put out different things about like the New York Stock Exchange or about NASDAQ. Those are the actual exchanges where you would take place. Those aren't all of them, but those are two popular exchanges. And then there are, just to give some definitions, the stock market overall refers to a collection of markets and exchanges where people are regularly buying and selling, trading all of their stocks. So this is the marketplace that could be considered the stock market. Some people will also call like just the economy in general. If you hear the economy's doing well, they could be referring to the stock market is doing well, that prices are really well, people are buying, their stocks are growing. And then there's a stock market index. So a market index is basically it's a portfolio, so a collection of maybe all of the top performing stocks. So these are all the top performing companies. Think of like household names like Apple, Microsoft, Walmart. Those very large companies could be part of an index. And since those are very large companies, they have a big effect on the market and they have a big effect on the market and their and kind of can indicate, so they're indicators, they indicate what the market will be doing. So if these large companies or the average of all of these large companies are doing well, then you can guess that maybe your investments or your portfolio is doing well because the average, the top companies are doing well. So we call those indicators, and the different types of indexes, you may have heard of the S&P 500, which stands for Standards and Poor 500, which is the top 500 companies that are doing well, public companies. And then there's the Dow Jones Industrial Average, which are more industry-related companies that are part of that portfolio. And so what is investing? So what do you guys think investing is? And what do you think the difference is between saving versus just investing?
The saving is just putting your money to sit in a savings account or at home if you don't want to put it in a bank. And investing would be taking that money and putting it into the stock market, buying individual names or index funds.
Yes, got it. Thanks, April. Okay, so yes, so exactly what April said. So saving is using your additional income that you have either monthly or at the end of the year to accumulate your monies. Typically, this is done with a savings account at your bank. It does not grow unless you're putting more money into it, and there's no risk associated with saving. Savings accounts do have their benefits, but they're best suited for, and I'm going to talk about this a lot, emergencies and particularly one-time purchases or short-term situations. Investing is a long-term strategy. So I would say that's the main difference is saving is potentially more for short-term and investing is for a long-term strategy. Investments do have the potential to grow, but they also have the potential to lose value. So there is risk associated when you are investing. As your investments grow over time, you should consider having a plan to preserve your growth. So you don't want to end up in a situation where you've grown all your money and then you lose it all because you didn't have a plan to make sure that the money you grew is staying at that value. You also want to have a plan to think about reinvesting your growth, as well as leveling up your investment strategy, which we'll talk about later as well. And then I also want to talk about volatility and risk and reward. So volatility in investing refers to up or down movements in the price of a stock over time. So when you first start investing, whatever price that you purchase your stock or your piece of a company in, it's not always going to be the exact same amount. So let's say you put in $100 or you purchase something for $100. That price is not always going to stay the same. And that's how prices fluctuate, or how your investment can lose value, as mentioned on the previous slide. So if the price goes down to $90, you've potentially lost $10. But if you stay in the invested, it could also go up to, let's say, $120. So it's grown. So it does move up and down, and it's not always going to be the same. And there's no guarantee of what the prices are going to be when you are investing. But you want to keep in mind that there is going to be fluctuations in your investments. It's not always going to be perfect. And then I also want to bring up risk. So risk is the chance that an outcome or investment's actual gains or growth will differ from the expected outcome. So as I said, it could go up, it could go down, and risk includes the possibility of losing some or all of your original investment. So you definitely want to keep that in mind as you're investing. And I would say riskiness, or how you take on risk, is a scale. So you can be risk averse, which means you do not want to take on a lot of risk, or you don't want to lose a lot of money potentially, or you can be very risk tolerant. So you have the potential to lose more, but you've also got the potential to gain more or grow more. So it's a scale of how much you want to take on personally. And in the chart, you can see that the lower potential for risk, there's also the lower potential for reward. The higher your risk is, the higher potential for the reward that you're going to get from your investment. But with that being said, with that potential risk, there's a potential for reward. There's also potential for great loss if you are more risk tolerant. So you want to decide your scale and where you are on the risk management scale. I see something in the chat. I'm just going to check. Oh, okay. I see people are taking notes in the chat. Okay, so next slide. So just to go over a little bit of the history of the stock market in the past. So let's take it way back, like let's say in the 50s or 40s, 30s, when someone wanted to invest in the stock market. It wasn't as simple as we have it today. You had to know someone that was in the stock market, or you had to be comfortable enough to make a call and say you want to purchase a stock. From the picture on the right, this is what the actual New York Stock Exchange was at one point. It was an actual location where if you wanted to buy a stock or sell a stock, you had to call up your stockbroker. And typically the most stockbrokers were male and white. So if you were not part of that community or did not have a connection, it was not necessarily possible or even thought of for you to be investing in the stock market. So that investment gap from the past has led to and has contributed to the wealth gap. So people who maybe have started invested in the past, or maybe their parents or grandparents began investing because they had the opportunity to, have been able to provide more for their families generationally throughout the years. So that has definitely contributed to the wealth gap that we're experiencing between Black America and other races in America. But with the stock market today, we see that there's very little to no barriers to entry. It's as simple as downloading an app, or maybe even using an app you already have that I'll talk about soon, and just building a good foundation and education. So I hope today that I give you guys a good foundation for you guys to get started, so you can really just at least take the leap, do something small. You don't have to go crazy, but at least do something if you're able to. So in the Black community and minority communities, even with the low barriers to entry, the fact that you can literally download an app, you don't have to call someone or know someone at the stock exchange to be able to purchase stocks. We still notice that minorities are still risk averse and don't want to begin investing because maybe they haven't had the exposure or don't see the representation when attempting to get started, or just haven't had the conversation with anyone. So they still prefer savings and don't necessarily have a good starting point. So we're gonna get you guys that today, so there's no risk aversion for those reasons. You can still have risk aversion for other reasons. So what are some of the reasons you guys think you should invest, or what is something that you would want to invest for in your future?
Typically for the long term, it's for retirement. So once you're no longer working and you still need a steady paycheck, then when you're investing in an investing account, and that money can come back to you once you're no longer working.
Right, yes, thank you, April. And I think said something too, like having your money work for you. That's good. And while you're still working, making sure you're setting up for the future.
Yeah, some people also invest for income, you know, so immediate, not in the long term, but just right now money. Some people participate for that reason as well.
Mm-hmm. Okay, yeah. Okay, well, these are all great reasons. So there are okay. There are definitely the reasons that you personally want to invest. So as I mentioned before, long-term goals. You also want to plan for your retirement. The students that are still in high school, if anyone's still on that was still in high school, or if you've got kids planning for college, maybe you have large purchases, or as Brian said, like income today, like you want to be able to have money for yourself right away. So those are reasons that you want to invest, and that can be a little different from your actual investment strategy and what the money will do for you. So I believe Sam said how you want your money to work for you. So your investment strategy is how your money is going to work for you. So there's different strategies. Most of the time when people are getting started in stocks, they want to see some sort of growth. They want growth, growth, growth. There's also income generation. You want to start getting income back from your investments. And you'll sometimes, maybe you come into some money, you won, I don't know, a few $1,000s, or you inherited some money and you just want to preserve that money. You don't necessarily know what you're going to do with it, but you want to preserve that. So that's preservation of capital. Or maybe you have a high tax bill and you want something that's going to be tax advantage, that's not going to eat away at your taxes or having to cause you to pay a lot of taxes. For this one, I'll say always consult a tax professional. I am not a tax professional, but if there's any investments you see that promise tax advantages, you also want to consult with your tax professional. So before you actually get started with investing, you always want to have a foundation in savings. You want to have an emergency fund because of the potential for loss when investing, the risk associated with investing. You want to have an emergency fund for in case anything happens. Typically a good emergency fund, a few months worth of expenses. So if you've got, if you know how much your bills are each month, you want to plan for 3 to 6 months of those expenses just in case. And then you also want to know the why of your investment, so what you're investing for. That will help you decide what investment strategy you're looking for. You also want to establish milestones so you know when you've reached your goal so that you can preserve that money or use it for what you're planning to use it for, when to maybe take it to the next level, and when to get out of that investment. So maybe you're not seeing the results, it's been a while, you've been patient, and it's not working, or that strategy is not working. You got to know when to leave that investment. And then you want to remember that investing now will always be better than later. There's a term called compounding interest, and it kind of goes hand in hand with investing. As you invest, there's growth. So let's say you had the opportunity to invest today and you miss that opportunity, or you don't take it. So let's say you could have invested $100 today. Next year, that investment, had you invested it, could have grown to maybe $120. So in that year, you missed out on the growth of $20, but at the end of, or excuse me, if you had invested that $120 and it came to next year, you could have the opportunity to let that $120 grow more. So any growth that comes off of the extra $20 is even more that you could be experiencing. But if you did not invest a year ago, then you miss out on that potential for growth. So just a few quick tips again before you get started is on the left. So understand that there's a learning curve. Everything, you're not going to know everything before you begin, but it's best to just start somewhere. It's also good to know when it's time to contact a financial professional. Let's say you've gotten the hang of it, or maybe you want to start using some different strategies and you don't know really where to go. Then find a resource, find a financial professional that you can trust. You also want to consult a tax professional again, and I would also make sure that you prioritize organizing your investment documents, keeping track of what you are investing, what you're saving, what you're losing. And some two good resources for that are Personal Capital, where you can make an account, and mint.com, where you can actually link your accounts and it will track it for you. Okay, so where do you start? Does anybody here actually invest themselves? Where did you start, or where have you thought about starting?
I started first at work. I mean, obviously with my 401k, but then I, created my own personal account with Charles Schwab so that I could have more access to other funds. But also listen a lot to Robinhood and take a look at Robinhood's apps so that I can see new things that are coming up and that I can possibly invest in.
Okay, good. I see something in the chat. Sydney says she started on Wealthfront, Coinbase, and Robinhood. Okay.
Yeah, like a lot of people who are just beginning investing, I guess personal investing outside of 401ks, I started on Robinhood as well. I use different accounts, Robinhood, E-Trade, Webull, but 401k as well.
Okay, I see Desire said you started on Coinbase, Fidelity app, TD Ameritrade. Okay, so some of these are ones that I'm going to talk about today too, but there are plenty of resources out there. The list that I'm going to give you guys, it's not exhaustive at all. There are lots of resources out there. This is just a jumping off point for everyone. Okay. So what is the difference between a consumer and an investor? I've already got the answers up here, but I was going to ask this one. So I would say a consumer is someone who really thinks reactively. So every decision that they make about money is reactive. So I've got something that I need to do now, so I'm going to spend this money that I have in my account. Usually this is for short-term goals. So some examples would be like saving for furniture, you're remodeling, something like that. Or maybe you've got a vacation planned and you've got the money, so you're going to spend that money now. Those decisions are based on current necessities. And an investor makes more proactive use of their money, thinking about long-term goals, so retirement, maybe you want to invest in real estate. So really you want to start sacrificing the current needs and wants that you have for your future payoff. So it's really a sacrifice that you're making, even though you have extra money left over at the end of the month, you're using it wisely to begin investing in yourself. So how do you shift? First, you want to have the ability and freedom to use disposable income. So if you have extra money at the end of the month and you know you've been maybe eating out every week and you have the opportunity to use maybe some of your extra income to start investing, you want to think about where you can make those cuts and start thinking about sacrificing some of the wants that you have. You have to have a lot of patience and time for investing. Something that's come up several times already is retirement. If you're very far away from retirement, that is a very long-term strategy. It's also a risk management strategy as well. So we talked about how risk is a scale. You can be risk averse all the way up to risk tolerant. If you've got a long-term strategy, that risk may change as you as time goes on. So when you're young, you're 18, you're just graduating, you have many years, you have decades before typical retirement age. I won't say when you guys are going to retire, but typical retirement age is in your 60s or 70s. And that's a very long time away. So you may want to be more risk tolerant. You want to take on more risk when you're younger versus when you are getting a lot closer to retirement in your 50s and 60s. So then you'd want to be more risk averse. So it's about managing the risk that you want to take on in your personal life and for your personal goals. And you also want to educate yourself. So we're doing a great job. We're all here together today educating ourselves on investing for our future. And you want to just make sure that you always find resources. Don't be afraid to ask for help or just bring up the discussion among yourselves or your friends. Take the information you're learning today, share with other people, and just talk about what you're doing or what you can do better. Just find someone that you can just talk with or find an online resource that you can go to. So going over some of the basics and what should you know about stock market investing. The number one goal I would say is to keep pace with inflation. So inflation is the general increase in prices and the decrease in the purchasing value of money. So $1 in 1970 could buy you a lot more than $1 could buy you 50 years later in 2020. So I have the prices of bread here. I know people give like examples of like, man, Coke was like 50 cents back in my day. But here are some prices from 1930 all the way up to 2010 of how the price of bread has gone up. Bread hasn't changed, but the value or the dollar amount that's placed on bread has. So you don't want to invest, let's say $100 in, let's say you invested $100 in 2000 and you want to get that investment back today. You don't want to get $100 back because that $100 is not